If you're earning $75,000 in 2025 and want to buy a home, this year's lending rules could change your plans. Lenders still use your debt-to-income ratio to decide how much you can borrow, but the cap has dropped from 50% to 43%. That means you may qualify for less than you expected, even though your income hasn't changed. In this video, I'll walk you through exactly how these new 2025 rules cut your borrowing power, so you know what price range is realistic. I'll also show you why the bank's top number may leave you house poor if you're not careful. Understanding these changes is the first step before you start house hunting. Why 2025 lending rules changed everything. A lot has changed in how lenders decide how much you can borrow for a home in 2025. The Federal Housing Finance Agency introduced new rules this year, and they affect every borrower, whether you're buying your first place or moving up. The most important shift is to the debt-to-income ratio, or DTI. In 2024, you could get approved for a mortgage with a DTI as high as 50% if you had strong credit and steady income. Now, for most conventional loans, the DTI cap is down to 43%. Some lenders set it even lower, especially if your credit score is average or you have other risk factors. This change alone cuts the maximum loan amount for many buyers, even if their income and debts haven't changed. Credit score standards are also higher this year. In 2024, a score of 620 got you in the door for most conventional loans. In 2025, the minimum is 640. If you want access to the best interest rates, you'll need at least a 700. Lenders pay closer attention to your recent credit activity, too. Every hard inquiry made in the last 6 months can reduce your approved loan amount by a small percentage. So if you've been applying for other credit, expect a closer review. A third major change is the new stress test rate. Lenders don't just use today's interest rate when they calculate what you can afford. Now they qualify you at the higher of your actual rate plus 2%, or a minimum floor of 5.5%. This rule is meant to make sure you can still pay your mortgage if rates rise, but it also means you'll likely qualify for a smaller loan than you would have last year. For many buyers, this buffer is the single biggest reason their approval amount drops in 2025. Other factors also matter, but the three above are the biggest hurdles for most buyers. Government-backed loans like FHA, VA, and USDA have their own DTI and down payment rules, which sometimes allow more flexibility. But even those programs have tightened up in response to the new national guidelines. Lenders are more thorough in verifying your employment and income. They want to see not just that you have a job, but that your work history is stable and continuous. Expect to provide extra pay stubs and more documentation if you've changed jobs recently or have any gaps in employment. For self-employed borrowers, underwriters now ask for 3 years of tax returns, and they'll look closely at year-over-year income trends. Processing times are longer across the board. Lenders now lock your rate for 45 to 60 days, so you'll need to be patient as they check more documents and review your finances in greater detail. Recurring payments like car leases, student loans, and even streaming subscriptions get extra attention. While not all monthly subscriptions count directly against your DTI, underwriters may flag your file if these expenses add up to more than 5% of your gross income. First-time buyers feel these changes the most. Without home equity or a long credit history, they face stricter limits and may need larger down payments or a cosigner to qualify for the same price range as last year. Repeat buyers with strong credit and assets are better positioned, but everyone should expect more conservative calculations from lenders. Now that you know what's driving these tighter rules, it's important to see exactly how lenders apply them to your finances. The next step is understanding how debt-to-income ratios work under the 2025 guidelines and what numbers you'll need to hit for approval. The 2025 debt-to-income breakdown. When you apply for a mortgage in 2025, lenders pay close attention to your debt-to-income ratio, or DTI. This simple formula compares your monthly debts to your gross monthly income, and it's the main number that determines how much you can borrow. For most conventional loans this year, you qualify if your total monthly housing costs, meaning your mortgage payment, property taxes, and homeowner's insurance, stay under 28% of your gross pay. All your monthly debts combined, including housing, car payments, student loans, and credit cards, must stay under 43%. These caps are stricter than last year's, and they apply to nearly all buyers unless you qualify for a special program. Government-backed loans like FHA, VA, and USDA do have their own guidelines, but the basics are similar. FHA loans can sometimes approve up to 50% DTI in special cases, especially if you have a strong payment history and extra savings, but most buyers will see the same 43% cap as conventional loans. VA and USDA loans have their own formulas, but unless you're eligible for those programs, the main 28 of 43 rule is what you'll face. We'll get into the details of those programs later, but for now, focus on the conventional limits. Your credit score has a direct effect on how much wiggle room you get with DTI. Higher scores, usually above 740, can sometimes let you stretch your DTI by 1 to 2% beyond the standard cap. On the other hand, if your score falls below 680, lenders might set your DTI maximum at 40 to 42%. This means that improving your credit score before you apply can make a real difference in how much you're allowed to borrow. Lenders count a wide range of debts when they run your DTI numbers. These include car loans, student loans, minimum credit card payments, personal loans, alimony, and child support. If you have deferred student loans that will enter repayment within the next year, those are included too. Federal student loans under income-driven repayment plans often count as $0 to $100 per month in these calculations, which can help if you have a large balance but a low required payment. However, utility bills, health insurance, and most subscription services are not included in DTI. Lenders focus only on debts that show up on your credit report or are legally required. If you're self-employed, lenders now average your last 3 years of income and deduct business expenses before calculating your qualifying amount. This often results in a lower approved loan compared to W-2 employees with the same gross pay. For those who earn bonuses or overtime, only income with a consistent 2-year history counts in full. Otherwise, lenders may only use half of your extra pay when figuring your maximum loan amount. Recent changes also affect how lenders treat auto leases and credit card debt. For car leases, they total up your remaining lease payments and divide by the months left. Then add this figure to your monthly debt load. For credit cards, lenders use your minimum payment, but if that's less than 2% of your balance, they'll use the higher 2% number instead. This prevents applicants from artificially lowering their DTI by paying only the minimum right before applying for a mortgage. Rental history can also help, especially for first-time buyers. If you can show a 12-month record of on-time rent payments, now accepted via bank transfers or payment apps like Venmo, some lenders may allow a slightly higher DTI, usually by 1 to 2%. This is not a guarantee, but it can tip the scales if you're close to the cutoff. Understanding the 2025 DTI standards gives you a clear idea of what lenders see when they review your application. But qualifying on paper is only the first step. The next thing to consider is how your monthly mortgage payment breaks down, since that number needs to fit comfortably into your budget. Calculating your true mortgage payment. Understanding your mortgage payment means looking at more than just the advertised principal and interest. Lenders use a formula called PITI, which stands for principal, interest, taxes, and insurance. The principal is the part of your payment that reduces your loan balance each month. Interest is what you pay the bank for lending you the money. Property taxes are set by your local government and can vary widely depending on where you live. Insurance covers both homeowners insurance and, if your down payment is less than 20%, private mortgage insurance, PMI. Let's break down how these numbers look in 2025. On a $300,000 loan with a 6.5% interest rate, the principal and interest portion comes out to about $1,896 per month. Property taxes average 1.1% of the home's value each year. So for a $300,000 house, that's around $275 per month. Homeowners insurance typically adds another $125 monthly, but this can be much higher in areas with severe weather risks or high rebuilding costs. If you put down less than 20%, PMI is required. In 2025, PMI rates are now credit-based. If your credit score is 680 or higher, you may pay between 0.3% and 0.75% of the loan amount per year, or roughly $75 to $188 per month on a $300,000 loan. With a score below 680, PMI can climb to $312 monthly. Some lenders now also require an upfront PMI payment at closing, adding to your out-of-pocket costs. A major shift for buyers in 2025 is how property taxes can change your monthly payment. Many counties reassessed home values after recent market surges, and some areas saw tax bills jump by 20% to 40%. Lenders must now use the current property tax amount and add a 3% annual increase when qualifying you. So if last year's tax was $3,000, you might be qualified based on $3,600 instead. In high-tax states, this can make a big difference, sometimes adding hundreds of dollars to your monthly obligation. Insurance costs also vary by region. Homes near the coast or in wildfire-prone areas pay much higher premiums. Some buyers in flood zones are required to carry separate flood insurance, which can add $100 to $500 monthly. In hurricane-prone states, you might need an extra windstorm policy, which could tack on another $150 to $300 per month. Lenders now look closely at how much your new mortgage payment will differ from your current housing costs. If your new payment is more than 50% higher than what you currently pay in rent, you'll need to show how you'll manage the increase, either by documenting extra savings or showing a reduction in other expenses. Loan choices also affect your payment. A 30-year fixed-rate mortgage has higher monthly payments than an adjustable-rate mortgage, ARM, at first, but ARMs can adjust upward after a few years, sometimes by as much as 20% to 40%. In 2025, lenders qualify you for ARMs at the higher of the fully indexed rate or the start rate plus 2%, making it harder to qualify for the teaser rate alone. The length of your loan changes the monthly cost, too. A 15-year mortgage means higher payments, but much less total interest paid over time. For a $300,000 loan at 6%, a 15-year term costs about $2,531 per month, while a 30-year term is closer to $1,799. Some lenders now offer 40-year loans, which lower your payment but slow your equity growth and often come with higher rates. Paying points up front can reduce your interest rate. Each point costs 1% of your loan amount and typically lowers your rate by 0.25%. For a $300,000 loan, paying $3,000 could save about $53 per month. The break-even point for buying points is now usually 5 years instead of 4, since people are staying in homes longer. Your real monthly payment is usually higher than just pity. Most lenders require you to escrow taxes and insurance, which can add 20% to 30% to your base payment. You'll also need to budget for maintenance, generally 1% to 3% of your home's value each year, and utilities, which can be much higher than in an apartment. If your home is part of a homeowners association, those fees must be included in your calculations. Some lenders now cap the amount of HOA fees they'll consider when qualifying you, so a high HOA can limit how much you're approved to borrow. To get the most accurate estimate, use worksheets from local lenders that include your area's tax, insurance, and PMI rates. Online calculators often miss these details. Comparing multiple quotes is the best way to know your true monthly obligation. Once you've worked out your full payment, it's important to see how much of that is driven by today's interest rates. Even a small change in rates can have a big impact on how much home you can afford. Interest rates, the affordability killer. Interest rates have become the single biggest factor limiting what buyers can afford in 2025. Right now, the average 30-year fixed mortgage rate sits at 6.83%. This is up from 6.42% at the start of the year, and it's a sharp contrast to the 3.22% average seen just a few years ago in 2021. Even though the increase from last year's 6.4% might look modest, it has a significant effect on your budget. For every 1 percentage point rise in rates, your purchasing power drops by about 10%. If you earn $75,000, that shift alone could mean qualifying for $30,000 less home than before. Looking at the bigger picture, the long-term average mortgage rate over the past 50 years is about 7.76%. So, while today's rates feel high compared to the recent lows, they're not unprecedented. The real shock comes for buyers who remember rates under 3%. For example, someone who locked in a 2.75% rate on a $300,000 loan paid $1,224 each month for principal and interest. At today's rates, that same monthly payment only covers a $190,000 loan. That's a 37% drop in buying power, driven entirely by interest rates. The Federal Reserve plays a major role in these rate changes. While mortgage rates don't move in perfect step with the Fed's decisions, they react to the same economic signals. When the Fed raises its benchmark rate to fight inflation, mortgage rates usually follow. Currently, the Fed is hinting at possible rate cuts later in 2025, but any drop will depend on how inflation trends. If inflation slows, rates could settle in the mid-6% range by year's end, but there's no guarantee. Higher rates typically put pressure on home prices, but a shortage of available homes keeps values stable in many areas. The spike to 8% rates in 2022 and 2023 did slow price growth, but it didn't cause widespread declines. Many homeowners are holding on to their lower-rate mortgages, which limits new listings and keeps inventory tight. As a result, most markets are seeing flat prices or slight increases of 1% to 3% this year, though local trends vary. For buyers trying to lower their rate, buying points is an option, but the math has changed. Paying 1 point, equal to 1% of your loan amount, typically reduces your rate by 0.25%. On a $300,000 loan, that's a $3,000 upfront cost for about $56 in monthly savings. The break-even period is now around 54 months, so it only makes sense if you plan to stay in the home for at least 5 years. Fewer buyers are keeping their loans that long, so think carefully before paying for points. Government-backed loans offer slightly better rates than conventional loans. FHA loans average around 6.5%, VA loans about 6.25%, and USDA loans near 6.35%. These rates are typically 0.25% to 0.5% lower than conventional loans, but they come with extra costs like mortgage insurance or funding fees. VA loans offer the best deal for those who qualify, with no down payment and lower rates, though the funding fee can offset some of the savings. Your credit score has a bigger impact on your rate than ever before. A score of 760 or higher might qualify you for a 6.5% conventional rate, while a 680 score could mean 7%. If your score is under 660, expect rates of 7.5% or more. Every 20-point jump in your score usually lowers your rate by about 0.125%. On a $300,000 loan, improving your score from 680 to 700 could reduce your payment by $50 each month. Adjustable rate mortgages, or ARMs, are another option. A 5-to-1 ARM might start at 5.75% compared to 6.83% for a fixed loan, saving nearly $200 a month on a $300,000 loan. But after 5 years, the rate can adjust to 7.5% or higher. Lenders now qualify you based on the higher of the starting rate plus 2% or the fully indexed rate, so you may not get as much benefit from the lower initial payment. Locking in your rate is more important than ever. Most lenders now offer 45 to 60-day rate locks compared to 30 days in the past. Float-down options cost extra, but let you capture a lower rate if the market moves in your favor before closing. Since rates can swing by 0.125% or more in a single day, timing your lock can make a real difference in your total loan cost. Shopping around is key. Online lenders often post rates 0.25% to 0.5% below traditional banks, and credit unions can offer even better deals. Getting at least 3 quotes can save you thousands over the life of your loan. Don't assume your current bank will offer the lowest rate. Refinancing is a different calculation now. The old rule of refinancing when rates drop by 1% isn't as useful with higher baseline rates. Today, even a 0.75% drop might justify refinancing, but you'll need to weigh higher closing costs, which now average 2% to 3% of the loan amount. Most people who refinance plan to keep their new loan at least 5 years to break even. Some lenders now offer temporary buydowns to help with affordability. A 2-to-1 buydown, for example, lowers your rate by 2% the first year and 1% the second year before it returns to the full rate. This option requires an upfront fee, but can make the first 2 years more manageable. However, these loans end up costing more if you keep the home long-term, so they work best for buyers who expect their income to grow or plan to refinance. Interest rates set the framework for what you can borrow, but lender approval is only part of the story. The next step is to see how much home you'll actually qualify for with a $75,000 salary, and why that number might not fit your real-life budget. What lenders approve versus what you can handle. When lenders review your application, they focus on what their formulas say you can afford, not necessarily what will fit your actual budget. For someone earning $75,000 a year in 2025, lender approvals typically land between $225,000 and $275,000 for a home, assuming you have a 20% down payment and little to no other debt. This translates to a monthly payment in the range of $1,500 to $1,800, including taxes and insurance. But these numbers are based on gross income, not the amount you actually bring home after taxes and deductions. Gross income is the starting point for lender calculations, but take-home pay is what matters for your day-to-day living. On a $75,000 salary, you might see $4,500 each month after federal taxes, Social Security, health insurance, and retirement contributions. If your mortgage payment is $1,700, that's about 38% of your net income, even though lenders only see it as 28% of your gross. This difference becomes even more pronounced when you add in utilities, home maintenance, and other recurring costs that lenders don't count toward your debt-to-income ratio. Lenders use the 28 of 36 rule to set limits. Ideally, your mortgage payment should not exceed 28% of your gross income, and your total monthly debt payments, including housing, should stay under 36%. In 2025, underwriters apply these ratios more strictly, often leaving less wiggle room than in the past. While these standards provide a baseline, they don't reflect real-world spending patterns or unexpected costs. Looking at your personal budget tells a different story. After accounting for a $1,700 mortgage, you're left with about $2,800 per month for everything else. Typical expenses might include $600 for car payments, $400 for student loans, $800 for groceries, $300 for utilities, and $500 for transportation. This leaves a slim margin for entertainment, savings, or emergencies. Even a small unplanned expense can push your budget into the red if you're spending at the top of your lender-approved range. Emergency savings are another factor. Most lenders want to see at least 2 months of mortgage payments in reserve, but financial planners recommend building 6 months of living expenses. For someone earning $75,000, that means saving up to $27,000, a difficult goal for many buyers, especially those currently paying rent. Household structure also affects what you can handle. Dual-income households often qualify for more because lenders see less risk, but fixed expenses like utilities don't double just because 2 people are paying. If one earner loses their job, the payment can quickly become unmanageable. This risk is less for single earners, but the approval amount will likely be lower. Retirement contributions have a direct impact on affordability. Every dollar you put toward a 401k or IRA reduces your available cash for housing. For example, contributing 10% of your salary means $625 less each month to put toward a mortgage. While some buyers pause retirement savings to buy a home, this can have long-term consequences that lenders don't factor into their approval process. Maintenance and repairs are ongoing costs that can't be ignored. Experts suggest budgeting 1% to 3% of your home's value annually for upkeep, which translates to $2,500 to $7,500 a year on a $250,000 home. Major repairs, like a roof or HVAC replacement, can cost thousands and often come up with little warning. Location also plays a role in affordability. Urban homes might come with higher utility bills, parking fees, or special assessments. Suburban and exurban homes could mean longer commutes and higher transportation costs. These are not included in lender calculations, but will affect your monthly budget. Lifestyle choices matter too. Frequent dining out, travel, or hobbies can all reduce what you can truly afford for a mortgage. Lenders don't ask about these habits, but they make a big difference in your financial comfort. The gap between what lenders approve and what buyers can comfortably handle has grown in 2025. Higher rates and inflation mean that lender-approved payments now push many buyers to the edge of their budgets. Many financial advisors suggest aiming for a payment 20% below your maximum approval to maintain flexibility. Other expenses, like childcare, medical costs, and changes in employment, can quickly alter your financial picture. Lenders don't account for these, so it's up to you to leave room in your budget for the unexpected. Carefully reviewing your own numbers, rather than relying solely on lender limits, helps you avoid stretching too far. Once you know your comfortable payment, down payment strategies for 2025. Down payment strategies in 2025 look different than they did just a few years ago, and the options available can make a significant difference in both your upfront costs and your long-term monthly payments. The minimum required down payment depends on the loan program you choose. For conventional loans, first-time buyers can put down as little as 3%, while repeat buyers typically need at least 5%. FHA loans require 3.5% down if your credit score is 580 or higher, but that jumps to 10% if your score falls between 500 and 579. VA loans remain one of the few options with zero down payment for eligible service members and veterans, and USDA loans also offer no money down options in designated rural areas. Jumbo loans, which cover amounts above conventional loan limits, usually require at least 10% down, and some lenders ask for 20% or more for loans over $1 million. Putting down 20% is the traditional standard to avoid private mortgage insurance, but that's a major hurdle for many buyers. On a $250,000 home, a 20% down payment means coming up with $50,000 up front. For many, this isn't realistic, so accepting PMI until you reach 20% equity is common. PMI adds $70 to $150 per month, depending on your credit score and loan size. In 2025, lenders typically remove PMI automatically once you reach a 78% loan-to-value ratio, which is usually after 5 to 7 years of payments. Some lenders now offer lender-paid PMI, where you accept a slightly higher interest rate instead of monthly PMI payments. This can help with monthly cash flow, but it often costs more over the life of the loan. Gift funds are still allowed for down payments, but the documentation requirements are stricter than before. If you receive a gift, you'll need a signed letter from the donor stating the money isn't a loan, along with 2 months of bank statements showing the funds moving into your account. Gifts over $18,000 per donor are now subject to IRS reporting, and some lenders may ask to see proof that the donor can afford the gift, especially if the amount is large relative to their income. Down payment assistance programs have grown in 2025. Many states and cities now offer grants or low-interest loans that cover 3% to 5% of the purchase price. These programs usually have income limits, often between $75,000 and $100,000 for single buyers, and may require you to complete a homebuyer education course. Some employers in high-cost areas also offer down payment help as a benefit, with amounts that can range from $5,000 up to $25,000, sometimes with vesting requirements if you leave the job. The size of your down payment can affect your interest rate. Putting 20% down usually earns you a rate that's 0.125% to 0.25% lower than putting 5% down. Some lenders give small additional discounts for 25% or 30% down, but the benefit diminishes as the down payment gets larger. For jumbo loans, rate discounts can continue up to a 40% down payment. How you save for your down payment matters, too. If you plan to buy in the next 3 to 5 years, keeping your funds in a high-yield savings account or certificate of deposit is safer than investing in stocks. High-yield savings accounts now offer 4% to 5% interest, while the risk of market downturns could delay your purchase if you invest aggressively. Some buyers use a blended approach, keeping the amount they need in safe accounts and investing any surplus. Alternative paths like rent-to-own agreements are more common in today's market. These contracts allow you to rent a home with the option to buy later, with a portion of your rent credited toward your down payment. In 2025, these agreements must be recorded with the county and clearly define how the purchase price will be set. Some now include caps on the maximum mortgage rate you'll pay if you decide to buy at the end of the lease. Family loans are another strategy, but they must be properly documented. Lenders require a formal promissory note with a market rate interest rate to distinguish a loan from a gift. If structured correctly, family loans can count as secondary financing, but the monthly payments are included in your debt-to-income calculations. Most lenders require that these payments stay below 5% of your gross monthly income and be repaid over a 10-year term. Retirement accounts can also be used, but with restrictions. First-time buyers can withdraw up to $10,000 from an IRA without penalty, though you'll still owe income tax. With a 401k, you can borrow up to $50,000 or 50% of your vested balance, whichever is less, and must repay the loan within 5 years. Some state programs allow penalty-free withdrawals from retirement funds for home purchases if certain requirements are met. Some local governments and nonprofits offer secondary financing in the form of silent second mortgages or forgivable loans. Silent seconds require no payments until you sell or refinance the home, while forgivable loans reduce the balance each year you stay in the home, sometimes disappearing entirely after 5 years. These programs can bridge the gap if you're close to your savings goal, but not quite there. Choosing the right down payment strategy means weighing your upfront costs, monthly budget, and long-term financial stability. The right approach leaves you with enough reserves for emergencies and maintenance, not just the minimum needed to close. As you prepare to apply, another factor that can make or break your approval is your credit profile. Credit score secrets for better approvals. Lenders in 2025 have raised the bar when it comes to credit scores, and understanding how your score is calculated can make a real difference in your approval odds and the rate you're offered. For conventional loans, the minimum qualifying score is now 640, up from 620 in previous years. FHA loans still allow scores as low as 580 for a 3.5% down payment. But if your score falls between 500 and 579, you'll need to put down at least 10%. VA loans technically have no set minimum, but most lenders look for scores of at least 580 to 620. USDA loans generally require a 640 or higher, and jumbo loans, which cover larger amounts, usually demand a score of 700 or above. Credit utilization is one of the most influential factors in your score. Lenders look at both your total revolving debt and how much you owe on each individual credit card. The sweet spot is keeping your overall utilization under 10%, but staying below 30% is essential. Even if your total utilization is low, having any single card with a balance above 50% of its limit can cause your score to drop. Paying down balances before your statement date, or even making multiple payments each month, can help ensure that the lowest possible amounts are reported to the bureaus. If you need to improve your score quickly, certain actions are more effective than others. Paying credit cards down below 20% of their limits before the statement closes can boost your score in as little as a month. Disputing old collections, especially those nearing the 7-year mark, can sometimes result in their removal. Becoming an authorized user on an established account with a perfect payment history can help, but lenders now look more closely at how long you've been on the account and whether you actually use the card. Some will disregard authorized user accounts entirely if they suspect you're not the primary user. Removing late payments through goodwill requests is still possible, but success rates are higher if you have a strong overall payment history. Recent changes to how medical debt is reported have eased the impact on credit scores. Medical collections under $500 no longer count against you, and even larger unpaid balances hurt less than before. Paid medical collections do not improve your score, but they also don't count against you. Medical debt now only appears on your credit report after 180 days of delinquency, giving you more time to address bills before they affect your mortgage application. Lenders also consider the mix of credit you have. A healthy profile includes both installment loans, like auto loans or student loans, and revolving accounts, such as credit cards. Having only one type of account can slightly lower your score. Opening a small installment loan before applying for a mortgage can sometimes help, as long as you make on-time payments and keep balances low. Inquiry patterns are another area lenders scrutinize. Multiple mortgage inquiries within a 45-day window only count as one for scoring purposes, so rate shopping won't hurt your score if done within this period. However, applying for other types of credit, like auto loans or new credit cards, within 30 days of your mortgage application can raise concerns. It's best to avoid any new credit activity in the months leading up to your application. Rent reporting services have become more important. If your landlord or property manager reports your on-time rent payments to the credit bureaus, it can help establish a positive payment history, especially for first-time buyers. Even if your rent isn't reported, you can show canceled checks or bank statements for the past year to strengthen your application. Timing your credit actions matters. Most lenders prefer to see 2 months pass between any major credit changes and your mortgage application. Opening or closing accounts right before applying can cause your score to fluctuate, and it typically takes 30 to 45 days for changes to be reflected in your score. Checking your credit at least 90 days before you start the application process gives you time to address any issues. Lenders now pay closer attention to the differences between your 3 bureau scores. They use the middle score for approval, but if there's a gap of more than 20 points between bureaus, they may ask for explanations or additional documentation. Monitoring all 3 reports helps you catch errors or discrepancies early. Understanding how credit scores work and taking targeted steps to improve yours can open the door to better rates and smoother approvals. But even with a strong credit profile, many buyers overlook the extra costs that come with purchasing a home. These expenses can add up quickly and catch first-time buyers off guard. Hidden costs. First-time buyers. Mississippi. Many first-time buyers focus on the down payment and monthly mortgage, but there are a range of additional costs that can significantly affect your budget. Closing costs are one of the largest early expenses, averaging 2% to 5% of the purchase price in 2025. On a $250,000 home, you should expect to pay between $5,000 and $12,500. These costs cover lender fees, third-party charges, and prepaid items. Lender fees include origination, processing, and underwriting, which together often total 1% to 2% of the loan. Third-party fees include the appraisal, credit report, flood certification, and title services. Prepaid items are upfront payments for homeowners' insurance, property taxes, and daily interest from closing to the end of the month. Setting up an escrow account requires a substantial upfront deposit. Lenders usually collect several months of property taxes and insurance premiums at closing. In high-tax states, this can mean paying thousands more than you expected. Even if you opt out of escrow, you'll still need to show enough cash reserves to cover these expenses. Some lenders offer escrow alternatives, but these often come with slightly higher interest rates. Moving into your new home brings its own set of costs. Local moves for a 2-bedroom home can run $800 to $2,000, while cross-country moves are much more expensive. Renting a moving truck, paying for mileage, and insuring your belongings can quickly add up. If your move-in date doesn't align with your move-out, storage fees and extra rent may be required. Cleaning both your old and new homes also adds to the total. Furnishing a new home is another major expense. Outfitting a 3-bedroom house with basic furniture can cost $8,000 to $20,000. Appliances for an unfurnished kitchen typically run $3,000 to $7,000. Window treatments, flooring upgrades, and smart home devices can collectively add thousands more. These costs are rarely included in lender calculations, so buyers need to budget for them separately. Utility bills often increase when moving from an apartment to a house. For a 1,500 square foot home, expect to pay $400 to $800 per month on utilities, including water, electric, and trash service. Some areas require new residents to pay connection or activation fees, which can range from $200 to $500. Cable and internet costs also rise as you cover a larger space. Homeowners association fees vary by neighborhood. Basic HOAs may charge $100 to $300 per month, while communities with amenities or luxury buildings can exceed $1,000 monthly. Special assessments for major repairs or upgrades can add thousands unexpectedly. Lenders consider regular HOA fees in your approval, but generally don't factor in special assessments. Renovation and repair costs should not be overlooked. Inspection reports can reveal needed repairs that cost $5,000 to $15,000 or more. Cosmetic updates like painting and flooring often run several $1,000s. Older homes may require significant investment in plumbing, electrical, or roofing. Permit fees for renovations can add another layer of expense. Tax rules for homeowners have changed. The mortgage interest deduction now caps at $500,000 for single filers and $750,000 for joint filers. Property tax deductions are limited to $10,000, including state income taxes. Points paid on refinances must now be spread out over the life of the loan, and home office deductions require stricter documentation. Transfer taxes are another line item many buyers overlook. Certain states and cities impose taxes on property transfers, which can add several $1,000s to closing costs. These fees are listed on your closing disclosure, but may not be discussed early in the process. Home warranties can provide peace of mind, but they come with their own costs and coverage limits. Annual premiums typically range from $500 to $900, with service call fees and coverage caps. Major systems may require additional coverage, and many policies exclude pre-existing issues. Landscaping and maintenance costs can be substantial for new homeowners. Lawn equipment, irrigation, tree care, and pest control are all recurring expenses. In colder climates, snow removal adds another seasonal cost. Pest inspections and treatments are sometimes required before closing, depending on your location. While a basic inspection is inexpensive, treatments for termites or rodents can cost thousands. Ongoing pest control is another annual expense to consider. Careful planning for these costs will help you avoid surprises and keep your finances stable as you settle into your new home. For buyers looking to expand their options, understanding how to maximize your qualifying income is the next step. Salary stretching strategies. Stretching your salary to qualify for a larger mortgage or to improve your approval odds often comes down to how you present your income and what sources you can document. Lenders look for steady, predictable earnings, but there are several ways to boost your qualifying income if you plan ahead and keep thorough records. Side jobs and freelance gigs can count toward your qualifying income if you've reported them on your tax returns for at least 2 years. Lenders average this income over a 24-month period, so short-term or inconsistent side work usually isn't enough. If you drive for rideshare companies or sell products online, you'll need to supply 1099 forms and bank statements that show regular deposits. Some lenders may accept newer side income if you can show signed contracts or ongoing client work, but they'll want proof that the income is likely to continue. Bonuses and commissions are treated differently from base salary. In 2025, lenders require a 2-year documented history to count the full amount. Without 2 full years, only half of your average bonus or commission income will be included. Lenders use the lower figure between your most recent 2 years or your current year-to-date average. For example, if you earn a $75,000 base salary and $15,000 in bonuses, but have only 1 year of bonuses, lenders might only add $7,500 to your qualifying income. A consistent part-time job can also help. To count, you'll need at least a year of steady employment with no gaps longer than 30 days. Lenders check pay stubs and direct deposit records. If your second job adds $1,000 per month, that could increase your maximum loan amount by up to $50,000, depending on your debts and other factors. However, lenders will review your total work hours to make sure your schedule is sustainable. Rental income from investment properties or house hacking is another way to boost what you qualify for. Lenders typically count 75% of gross rent from leases, subtracting the mortgage payment on the property. For house hacking, living in one unit while renting out others, lenders will count rents from the other units if there are separate entrances and utilities. You'll need a lease agreement and proof of security deposits to document this income. For self-employed buyers, documentation is critical. Lenders want to see 3 years of tax returns that show either stable or increasing profits. They'll average your income over those years and may add back certain deductions like depreciation or business expenses. If your business shows $75,000 in gross receipts but heavy deductions, your qualifying income might be much lower after adjustments. A job offer letter can help if you're moving to a new position. The letter must specify your guaranteed salary, have a start date within 90 days, and be on company letterhead. Some lenders will call your new employer to confirm details. With a valid offer letter for $85,000, you may qualify for a higher mortgage before receiving your first paycheck. Co-signers can increase your purchasing power by adding their income to yours in the debt-to-income calculation. All of the co-signers' debts count as well, which can limit the benefit. Most lenders require the co-signer to live in the home, but some programs allow non-occupant co-signers with stricter requirements. Remote work can change where your salary goes furthest. If your job is fully remote, you can consider buying in a more affordable location. Lenders will ask for a letter from your employer confirming your remote status is permanent. This can be a practical way to make your income stretch, as long as your employer has no plans to require in-office work. Overtime income may be included if you've earned it consistently for at least 2 years. Lenders average your overtime pay over that period, and some cap the amount they'll count at 50% of your base salary. If you had a particularly high overtime year, only the average will be considered. Seasonal and union work require careful documentation. For seasonal jobs, lenders average your income across the full year and want to see 2 years of consistent patterns. Union workers need to provide proof of membership, wage scales, and seniority. Some lenders offer better terms for union members. Asset depletion can help buyers with substantial savings but lower regular income. Lenders divide your liquid assets by 360 months to create a monthly income stream. For example, $100,000 in savings could add about $277 per month to your qualifying income, but you must have these funds available after closing. Retirement, disability, child support, and alimony income are all considered if properly documented and likely to continue for at least 3 years. Lenders want to see award letters, court orders, and proof of consistent receipt for these sources. Some lenders may consider rental history if you've consistently paid more in rent than your proposed mortgage. With a year of canceled checks and a lease, the difference may be added to your qualifying income. Foreign income can also count if reported on U.S. tax returns for 2 years and likely to continue. Combining multiple strategies, such as adding a part-time job, documenting rental income, and verifying side gig earnings, can help you qualify for a higher loan amount. Each method requires specific paperwork and planning, so starting early is important. As you look for ways to stretch your salary, it's also worth considering how your choice of location can affect how far your money goes. Location-based affordability tricks. Regional housing markets in 2025 show some of the widest price gaps on record, making it essential to compare not just home prices, but the full cost of living in different locations. In cities like Pittsburgh and St. Louis, a $75,000 income can support a home close to the local median price, often around $250,000. By contrast, coastal metros such as San Diego or Boston limit buyers at this income level to smaller condos, with median prices well above $600,000. The spread between the most and least expensive large cities now exceeds 400% for similar properties. Some southern metros, including Atlanta and Houston, remain more affordable, with home prices 20% to 30% below national averages, even as job markets remain strong. Suburban and commuter towns offer a way to access lower prices while remaining within reach of major job centers. Moving 30 to 45 minutes outside a major city can reduce home prices by 25% to 40%. For example, a home priced at $400,000 in a city center might be available for $275,000 in a nearby suburb. These savings, though, must be weighed against higher transportation costs. Monthly train passes can range from $200 to $400, and driving from the suburbs adds expenses for fuel, maintenance, and parking. For some buyers, employer transit subsidies or remote work policies help offset these costs. Urban homes and suburban properties each come with their own ongoing expenses. City condos and townhomes often have higher HOA fees, covering amenities and shared maintenance. Suburban homes may require you to budget for lawn care, snow removal, and larger utility bills due to increased square footage. In many cities, parking costs $150 to $300 per month, while suburban homes usually include free driveways or garages. Urban utility costs tend to run 10% to 20% higher, as older buildings may be less energy efficient. Property tax rates can be a deciding factor when comparing locations. In 2025, effective property tax rates range from about 0.3% in Hawaii to over 2.5% in New Jersey and Illinois. That means a $300,000 home could cost $900 per year in Honolulu, but $7,500 in Chicago. Some states, such as California, limit annual assessment increases, while others reassess at full market value each year. Even within the same state, tax rates can vary significantly between counties, creating affordability pockets near metro borders. Insurance premiums also depend heavily on location-specific risks. Coastal areas face higher hurricane insurance costs, often 2 to 3 times the national average. Wildfire-prone regions in California and Colorado can add $100 to $300 per month to insurance premiums. Flood insurance, required in high-risk zones, ranges from $700 to $2,000 annually, and some neighborhoods with higher crime rates see premiums rise by 20% to 30%. Insurers may require separate windstorm policies in certain Gulf Coast states, adding another layer of expense. School district quality is another factor that affects both home values and ongoing costs. Homes in top-rated school districts often sell for 10% to 30% more than similar homes in lower-rated areas, and property taxes tend to be higher in these districts to fund education. Buyers who do not plan to use local public schools sometimes opt for areas with lower taxes and use the savings toward private school tuition or other expenses. Neighborhood trends can signal future affordability. Areas with increasing building permits, a growing number of owner-occupant buyers, or signs of new business investment often see price appreciation before these changes become widely known. Proximity to planned transit expansions can also boost long-term value, as can local job growth and stable industries. Flood zone designations require careful review. FEMA maps outline high-risk areas where flood insurance is mandatory, but recent climate shifts mean some risks are not fully captured. Checking local flood history and considering properties just outside official flood zones may help you find value without mandatory insurance requirements. Walkability and access to public transit can both increase home prices and reduce ongoing transportation costs. Highly walkable neighborhoods, with walk scores above 90, typically command 10% to 25% price premiums, but offer savings on car ownership. And commuting. Each 10-point increase in walk score correlates with higher home values, but also with reduced reliance on vehicles. State and local programs can make certain neighborhoods more accessible. Many states offer down payment assistance or low-interest loans for buyers purchasing in designated revitalization areas. These programs often come with income limits and may require you to live in the home for a set number of years. The type of property you choose also affects affordability. Condos generally cost less upfront than single-family homes, but have higher HOA fees. Townhouses and multifamily properties offer different trade-offs between price, space, and responsibilities. In some markets, tiny homes and accessory dwelling units provide lower entry points, though they may come with more restrictive covenants or limited financing options. Employer homebuyer programs are available in some regions, especially where large employers partner with local lenders or governments. These can include down payment assistance, reduced closing costs, or special financing terms, often in exchange for a multi-year employment commitment. Commuting alternatives such as ferries, light rail, or van pools can open up less expensive neighborhoods, while exurban telework hubs are becoming more common for remote workers. Access to community amenities, like libraries, parks, and recreation centers, can reduce other living expenses and improve quality of life. Zoning and development changes can signal shifts in affordability. Areas allowing more multifamily housing or accessory units may see increased supply and more stable prices. Tax abatement programs in some cities temporarily reduce property taxes for buyers in specific neighborhoods, but it's important to plan for higher taxes once the abatement period ends. Disaster resilience measures, such as improved flood control or fire-resistant building codes, can lower insurance premiums and protect long-term value. Some states offer grants for upgrades that reduce risk and cut costs. Taking the time to research these location-based factors can help you find neighborhoods where your income goes further and your long-term costs remain manageable. Once you've narrowed down where you want to buy, the next step is Loan Type Comparison Guide. Choosing the right loan type is a critical step, as each program comes with its own requirements, benefits, and trade-offs. In 2025, conventional loans require a minimum credit score of 640 for most lenders. First-time buyers can put down as little as 3%, while repeat buyers need at least 5%. Debt-to-income ratios are capped at 43% for most borrowers, though some lenders set the bar slightly lower. Private mortgage insurance, PMI, is required for down payments under 20%, and the cost is now more closely tied to your credit score, ranging from 0.3% to 1.25% of the loan amount per year. Interest rates for conventional loans average around 6.5%, but borrowers with excellent credit may see rates closer to 6.25%. These loans are best suited for buyers with strong credit and a moderate to large down payment. FHA loans remain a popular option, especially for buyers with lower credit scores or limited savings. The minimum down payment is 3.5% for borrowers with a score of 580 or higher. Those with scores between 500 and 579 must put down at least 10%. Mortgage insurance premiums for FHA loans are now credit-based, rather than flat, and include both an upfront charge of 1.75% and annual premiums between 0.45% and 1.05%. Debt-to-income ratios can go up to 43%, with some flexibility for applicants who have strong compensating factors like substantial cash reserves. FHA loan limits have increased in many markets, with a maximum of $620,000 in high-cost areas. These loans are often a fit for first-time buyers or those rebuilding their credit. VA loans have expanded eligibility, now including more National Guard members and reservists. The VA does not set an official minimum credit score, but most lenders require at least 620. VA loans allow 100% financing, so no down payment is needed, and there is no PMI. Instead, borrowers pay a funding fee that ranges from 2.15% to 3.3%, depending on down payment and service history. Debt-to-income ratios typically max out at 41%, but lenders also look at residual income to ensure affordability. Interest rates for VA loans are generally lower than other types, averaging about 6.25%. VA loans also allow some rental income from multi-unit properties to count toward your qualifying income. USDA loans are designed for buyers in rural or certain suburban areas. They require no down payment and have income limits based on local median incomes, usually around $110,650 for a household of up to 4. Properties must be located in eligible areas as defined by the USDA. Borrowers pay a 1% upfront guarantee fee and a 0.35% annual fee. Minimum credit scores typically start at 640, but some lenders may go lower. USDA loans use a 29% front-end and 41% back-end debt-to-income ratio, similar to conventional loans, and are a good fit for buyers who meet the location and income criteria. Jumbo loans are for amounts above the conforming loan limits, which are now $766,550 in most places and up to $1,149,825 in high-cost areas. These loans require larger down payments, usually 10% to 20%, and higher credit scores, often 700 or above. Lenders expect borrowers to have significant cash reserves, sometimes covering 6 to 12 months of payments. Interest rates for jumbo loans are typically 0.25% to 0.5% higher than conventional loans. Some lenders offer interest-only options, but qualifying is stricter, and these loans are best for buyers in expensive markets with strong financial profiles. Physician loans cater to medical professionals. They allow for zero down on loans up to $1.5 million and do not require PMI. Resident physicians can qualify based on future earnings rather than current income, and student loan debt is treated more leniently in debt-to-income calculations. Some programs now offer 40-year terms to lower monthly payments. Interest rates are usually about 0.125% higher than conventional loans. To qualify, lenders require board certification or an employment contract. Renovation loans, such as the FHA 203K and Fannie Mae Homestyle, combine the purchase price with renovation costs. FHA 203K loans require 3.5% down, while Homestyle loans need 5%. Both require licensed contractors and detailed bids, and the appraisal must reflect the value after improvements. Interest rates are 0.25% to 0.5% higher than standard loans. These products are useful for buyers looking to purchase and update older homes. Portfolio loans are offered by community banks and credit unions that keep the loans on their books. These loans can be more flexible, accepting alternative credit data or complex income sources. Down payments start at 20%, and interest rates are typically 1% to 2% above standard rates. Debt-to-income ratios may stretch to 45%. Portfolio loans are often used by self-employed buyers or those with unique financial situations. Construction loans cover the cost of building a new home and convert to a standard mortgage when construction is complete. Borrowers qualify based on the finished home's value, and funds are released in stages. Down payments are higher, usually 20% to 25%, and lenders require detailed builder contracts. Rates start as adjustable and convert to fixed after completion. These loans are suitable for buyers building custom homes or doing major renovations. Comparing loan types helps you match your financial situation and property goals to the right product. Each option comes with its own rules for credit, down payment, debt to income, and fees. Understanding these differences allows you to choose the loan that fits both your needs and the realities of the current market. The timing of your purchase can also have a major impact on affordability and availability, depending on seasonal patterns and market cycles. Timing the market wisely. Understanding when to buy can make a significant difference in both price and the selection of homes available. Home prices tend to follow a predictable seasonal rhythm. In most regions, prices reach their highest point between May and July, when demand peaks due to favorable weather, school breaks, and families aiming to settle before a new academic year. During the winter months, prices often dip by 5% to 10% compared to the summer, but the trade-off is a much smaller inventory. Spring brings a surge of new listings, but also more competition from other buyers. Fall can offer a middle ground, with more motivated sellers looking to close before the holidays and a reasonable amount of inventory still on the market. Regional differences matter. Southern cities may not experience as pronounced a winter slowdown, while northern cities see sharper seasonal shifts. Interest rates also play a critical role in timing. Forecasts for late 2025 suggest rates could ease into the mid-6% range if inflation continues its downward trend. The Federal Reserve has hinted at potential rate cuts starting in the third quarter, but rates remain sensitive to monthly economic reports, especially those covering inflation and employment. Monitoring these reports and understanding when the Fed is likely to make policy announcements can help buyers decide when to lock in a rate. Even a small drop in rates can increase your purchasing power or reduce your monthly payment. Inventory levels shift throughout the year. The largest increase in listings typically happens in spring, with new homes coming onto the market and builders completing projects. By May and June, buyers see the widest selection, but by late summer, sellers who haven't found a buyer may be more willing to negotiate. In the early months of the year, banks often list foreclosed properties as they clear out inventory from the previous year. Builder incentives, such as rate buydowns or closing cost assistance, are most generous during slower sales periods, especially at the end of the year or when a development is nearing completion. Tax deadlines and school calendars influence buyer and seller behavior. Many buyers aim to close by the end of December to take advantage of mortgage interest and property tax deductions for that year. Others use spring tax refunds as part of their down payment. School schedules drive a surge in family moves between May and August, especially in districts with early August start dates. Parents often begin researching school quality during the winter, which can affect when they start their home search. Economic indicators provide valuable context for timing a purchase. Rising unemployment or slowing GDP can signal softer home prices, while strong job growth tends to support higher prices and faster sales. Absorption rates, defined by how many months' worth of homes are on the market, help buyers gauge whether conditions favor buyers or sellers. A market with less than 3 months of inventory typically favors sellers, while 6 months or more gives buyers more leverage. Lease expiration dates can also shape strategy. Renters whose leases end in winter may find less competition and more negotiating power, while those moving in summer face stiffer competition for available homes. Some buyers choose to overlap rent and mortgage payments for a month or two to secure a better deal in a less competitive season. Patterns in price reductions can reveal motivated sellers. Homes that remain unsold after 3 weeks are more likely to see price cuts, often announced on Saturday evenings. The highest volume of price reductions tends to occur in July and January, making these months good times to look for discounted properties. Foreclosure and builder inventory cycles present additional opportunities. Banks typically list real estate-owned (REO) properties in the first quarter, and builders discount remaining units as developments near completion milestones. Corporate relocation cycles, bonus seasons, and even weather patterns, like hurricane or wildfire seasons, can all impact local market dynamics. Election years and local policy changes can introduce uncertainty, sometimes slowing higher-end sales or affecting development plans. In addition, new construction deliveries often follow permit cycles, with homes permitted in spring typically available the following year. Tracking these timelines through local planning departments can help buyers anticipate when more inventory will hit the market. Retirement and college town markets have their own seasonal patterns, driven by snowbird migrations or faculty relocations. Understanding these cycles can help buyers in these areas plan their search for the best timing. By paying attention to these timing factors, seasonal price shifts, interest rate movements, inventory cycles, and local economic trends, buyers can better position themselves to find the right home at the right price. Once you've identified the optimal window for your purchase, knowing how to approach negotiations can help you secure the best possible terms. Negotiation tactics that still work. Negotiating in today's market requires a clear understanding of which tactics remain effective and how to tailor your approach to the property, seller, and current conditions. Seller concessions are one of the most useful tools for buyers. The maximum allowed varies by loan type. Conventional loans permit up to 3% of the purchase price in concessions for buyers putting down less than 10% and up to 6% for those with larger down payments. FHA loans allow up to 6% in seller credits, while VA loans technically have no cap but are limited in practice by the appraisal value. These concessions can be applied toward closing costs, prepaids, or even to buy down your interest rate. When making an offer, it's often effective to request the maximum allowed for your loan program to offset out-of-pocket costs. Inspection negotiations have shifted as markets have become more competitive. Focus on safety issues and significant defects rather than minor cosmetic flaws. Requests for repairs are generally taken more seriously than requests for credits, but providing contractor estimates for needed work gives your requests more credibility. Some buyers choose to waive the inspection contingency to make their offer more attractive, but still conduct an informational inspection for peace of mind and potential leverage. In older homes, asking for credits instead of repairs can be more appealing to sellers who want to avoid additional work. Appraisal gaps are a common challenge, especially in appreciating markets. If the appraisal comes in below the contract price, you have several options: negotiate a price reduction, split the difference with the seller, or pay the gap in cash. Some lenders may allow a second appraisal if you can provide strong comparable sales data. If the gap is small, sellers may be willing to lower the price to keep the deal moving. For larger discrepancies, shortening the closing timeline or increasing your earnest money deposit can be used as bargaining chips. Closing cost credits are another flexible negotiation point. Sellers can contribute up to the allowed percentage toward your non-recurring closing costs, but these credits can't be used for your down payment or certain prepaid items. Structuring your request as a percentage rather than a fixed dollar amount accounts for variability in final costs. If credits exceed actual closing costs, the surplus may be applied to prepaids or a principal reduction, depending on the lender's policies. Rate lock extensions are sometimes needed if the transaction is delayed. These extensions typically cost between 0.125% and 0.25% of the loan amount per week. If delays occur through no fault of your own, negotiate for the seller to cover these costs. Standard lock periods are now 45 to 60 days, but lenders may offer a 15 to 30-day extension without a new underwriting review if rates are stable. Some allow a one-time float down or extension for construction delays, so ask about these options before you commit. Leaseback agreements can be helpful when sellers need extra time to move. A typical leaseback runs for 30 to 90 days, with a security deposit held in escrow. Set the daily rental rate based on the mortgage payment divided by 30, and clarify who is responsible for utilities and maintenance. Some buyers accept a below-market rent in exchange for additional repair concessions. Always ensure your insurance policy covers the period when the seller remains in the home. Home warranties are another negotiation point. These typically cost $500 to $900 annually and cover major systems like HVAC, plumbing, and electrical. Negotiate for the seller to pay for a warranty covering the first year or two, especially if the home has older systems. Add-ons for appliances or pools are available, but be aware of service call fees and coverage limits. Personal property can be included in negotiations. Items like refrigerators, washers, dryers, window treatments, and patio furniture can be requested as part of the deal. These items don't impact the appraised value, but can save you significant money up front. Make sure all inclusions are clearly listed in the purchase agreement to avoid confusion at closing. The timing of contingency removals can influence your leverage. Inspection periods usually last 7 to 10 days, while loan contingencies average 21 days but vary by lender. Faster removals can make your offer more attractive, but reduce your protection if issues arise. Consider removing contingencies in stages. First inspections, then financing, to balance risk and competitiveness. Some buyers negotiate for seller concessions before removing contingencies, but always consult your agent before waiving any protections. Market conditions shape which tactics are most effective. In buyers' markets, you can negotiate for more repairs, credits, and closing cost help. In balanced markets, quick closes and flexible terms are valued. In sellers' markets, you may need to present a cleaner offer, but can sometimes negotiate post-offer credits or repairs. Always review recent comparable sales before making requests to support your position. Multiple offer situations require a different approach. Escalation clauses, where you agree to beat competing offers up to a set limit, can be useful, but not all sellers favor them. Personal letters sometimes influence individual sellers. Shorter contingency periods, larger earnest money deposits, and free rentbacks can help your offer stand out. New construction negotiations differ from resale transactions. Builders more often offer design center credits, free upgrades, or appliance packages rather than price reductions. Timing your purchase near the end of a quarter or year can unlock better incentives. Builder rate buydowns can provide more value than a lower sale price. Bank-owned properties and short sales follow stricter protocols. Asset managers for REOs rarely negotiate repairs and typically expect offers close to the appraised value. Closing cost credits are limited, and quick, clean offers with strong pre-approvals have the best chance. Short sales involve lengthy approval timelines and lender-driven price decisions, so patience is required. Estate sales can present unique opportunities. Executors may prioritize a fast, uncomplicated sale over achieving the highest price. Personal property is often easier to negotiate, and closing timelines may be driven by probate or tax considerations. Applying these negotiation tactics can help you secure better terms and reduce your upfront and ongoing costs. As you prepare for closing, it's also important to think about how the property you choose will serve your needs over time. Future-proofing your purchase. Future-proofing your purchase means looking beyond your immediate needs and considering how your home will adapt to changes in your life and the market. Start by evaluating the property's potential for long-term value. Homes in areas with stable school districts and a record of steady price growth tend to maintain value over time. Neighborhoods that have seen moderate appreciation, rather than sharp spikes, are less likely to experience steep corrections. Properties with standard layouts, like 3-bedroom homes with functional floor plans, appeal to the widest pool of future buyers. Avoid homes with highly specific or trendy renovations that could limit resale interest. It's also wise to check local zoning and municipal development plans to ensure no upcoming changes could negatively affect your investment. Work and lifestyle patterns continue to evolve, so flexible living spaces are increasingly important. With remote and hybrid work more common, a dedicated home office or a space that can easily be converted for work is a valuable feature. Good natural light, privacy, and reliable internet access are key considerations. For dual-income households, homes with 2 adaptable workspaces offer more day-to-day flexibility. Look for properties with existing Ethernet wiring, or at least the infrastructure to add it. Sound insulation between living and work areas is now a practical benefit, especially as more work is done from home. Some lenders recognize the value of dedicated home office spaces when considering appraisal or refinance requests. Consider accessibility and adaptability for all stages of life. Single-story homes or properties with a main-floor bedroom and bathroom offer easier access and are more accommodating as needs change. Wider doorways, step-free entrances, and lever-style handles instead of knobs provide flexibility for different mobility requirements. Walk-in showers that can be reinforced for grab bars are a practical upgrade. Some states provide tax incentives for certified aging-in-place renovations, making these features valuable for both comfort and long-term planning. Energy efficiency is another area that pays off over time. Updated HVAC systems, modern water heaters, and efficient appliances lower utility costs. Double-paned windows and upgraded insulation help manage heating and cooling expenses. Solar-ready homes, or those with existing solar panels, often command higher prices in markets where utility costs are rising. Energy Star certification can also make a property eligible for certain loan programs or rebates. Many utility providers offer free or low-cost home energy audits, which can highlight additional ways to improve efficiency. Flood risk is a growing concern in many regions. Review FEMA flood maps, but also consider local floodplain management plans and recent weather history. Properties with proper drainage, elevated foundations, or recent flood mitigation work are less likely to face insurance hikes. Some neighborhoods have invested in flood control projects that may not yet be reflected on official maps, so check with local agencies for updates. Anticipate how climate trends could impact flood risk over the next 20 to 30 years. Rental flexibility can add a layer of security to your investment. Homes with separate entrances, finished basements, or accessory units offer the option for long-term or short-term rental income. Always verify local ordinances and HOA rules before factoring in rental potential. Properties near hospitals, universities, or major employers tend to have stronger rental demand. Some lenders will count projected rental income toward your qualifying amount if the unit meets specific criteria. Accessory dwelling units, ADUs, are becoming more common as cities relax zoning restrictions. A detached or attached ADU can provide space for family, guests, or tenants. Check local rules for setbacks, size limits, and utility connections. Some municipalities have pre-approved ADU designs to streamline the permitting process. Properly permitted ADUs often add 5% to 15% to a property's value. Smart home features are increasingly standard. Hardwired security systems, smart thermostats, and automated lighting offer convenience and can reduce insurance costs. Focus on systems with broad compatibility rather than those tied to a single brand. Older homes may need wiring upgrades to support these features. Some insurers provide discounts for properties with monitored security and leak detection, which can offset installation costs. Neighborhood development plans can have a lasting impact. Review city or county planning documents for upcoming infrastructure, transit, or commercial projects. New transit lines can increase accessibility and property values, while large commercial developments may bring both amenities and traffic. School district boundary changes and infrastructure upgrades can also influence future desirability. Publicly available 10 or 20-year development plans provide clues about how the neighborhood may evolve. Document all upgrades and keep records of repairs or improvements. This helps demonstrate value when you sell and can make the appraisal process smoother if you refinance. Homes that combine adaptability, energy efficiency, and flexibility tend to hold value across different market conditions and life stages. Thinking ahead and choosing a property that can adapt to unexpected changes gives you more control over your investment. Even with careful planning, though, there are pitfalls that can jeopardize a purchase. Knowing what to watch, red flags that kill deals now. Some of the most common deal breakers in 2025 stem from stricter underwriting and more detailed documentation requirements. Lenders now scrutinize every aspect of a borrower's financial profile, and even minor issues can halt the approval process. A single missed payment in the past year draws attention, and small overdrafts or unexplained deposits in bank statements get flagged for further review. For any deposit over $500, you'll need to provide a clear paper trail showing its source. Self-employed applicants face heightened standards, with 3 years of tax returns required instead of 2. Automated underwriting systems speed up decision-making, but also issue denials more quickly when something doesn't add up. Income documentation is a frequent stumbling block. Lenders compare pay stubs, W-2s, and tax returns to verify consistency. If numbers don't match, a written explanation is required, and unresolved discrepancies can stall or end the process. Bonuses, overtime, and variable pay must be documented for at least 2 years to be counted. Changing jobs within the previous 2 years often triggers additional employment verification, and switching from W-2 to 1099 status can make qualification more complicated. For self-employed borrowers, business expenses reported on tax returns often reduce qualifying income, and not all deductions can be added back. Contractors working on 1099s find it more difficult to qualify compared to salaried employees, even if their gross earnings are similar. Debt-to-income calculations are another area where mistakes can cost buyers their approval. Lenders now count deferred student loans if they are scheduled to enter repayment within 12 months, and they include child support or alimony payments even if not listed on a credit report. For credit cards, the higher of the actual minimum payment, or 2% of the balance, is used. Car leases are calculated based on the remaining payments divided over the term. Buyers sometimes overlook future increases in property taxes, insurance, or association fees, which can push their ratios above lender limits. The property itself can introduce red flags. Appraisers note required repairs, and lenders won't release funds until these are completed. Roofs with less than 3 years of life, outdated electrical systems, or structural issues can all stop a loan from closing. FHA and VA loans have additional property standards, and even cosmetic issues like peeling paint can delay government-backed financing. Skipping an inspection may seem like a way to speed up the process, but lender-mandated repairs can still arise after appraisal. Title issues also derail transactions. Unpaid liens, unresolved boundary disputes, or incomplete title transfers from inheritance or shared ownership arrangements must be resolved before closing. Easements for utilities or access can affect lender decisions, and timeshares or co-ownership structures complicate the title process. While title insurance offers some protection, it can't prevent all closing delays. Appraisal shortfalls present another challenge. When a home appraises below the purchase price, buyers must either cover the difference in cash or renegotiate with the seller. In rising markets, appraisals may lag behind current prices, especially for unique or heavily upgraded homes. Buyers can submit additional comparable sales to contest a low appraisal, but lenders may not always accept these, and deals can fall apart if the gap is too large. Delays that push a transaction past a rate lock expiration can create unexpected costs. Extending a rate lock typically adds 0.125% to 0.25% of the loan amount per week. Not all lenders will extend locks beyond 60 days, and if market rates have increased, buyers may find themselves priced out. Construction projects that run late risk forcing buyers to accept a higher rate or restart the approval process. Employment changes during escrow are a major risk. Lenders verify employment just before closing, and any change in job, pay structure, or employment status can require a full re-underwrite. Moving from salary to commission, taking a leave of absence, or switching employers, even for a promotion, can all prompt additional review or even a denial. Credit report problems are another common issue. Outdated account statuses, paid collections still showing balances, or identity mix-ups can lower scores and trigger lender questions. Disputing errors during the loan process can slow things down, so reviewing your credit well in advance is essential. Opening new credit or increasing debt during escrow can also sink a deal. Financing furniture, applying for new cards, or taking out an auto lease before closing will raise your debt-to-income ratio and may prompt lenders to recheck your credit. Even small increases in balances can push you over the limit. Certain property types have their own hurdles. Condos must meet lender occupancy and financial requirements. Manufactured homes need permanent foundations. Co-ops and mixed-use properties have more limited financing options, and buyers sometimes discover late in the process that their chosen property does not qualify. Documentation lapses are a final source of preventable delays. Tax transcripts must match filed returns. Business records for self-employed applicants need to be complete, and all gifts for down payments require formal documentation. Divorce decrees, child support orders, and profit and loss statements must be up to date and available on request. By staying ahead of these red flags and preparing documentation early, buyers can reduce the risk of last-minute surprises. When traditional financing proves difficult, some buyers look for alternative ways to achieve homeownership. Alternative paths to ownership. Alternative paths to homeownership have become more visible in 2025, as buyers look for options outside of traditional mortgages. Rent-to-own programs, for example, now come with more structured terms. Most require an upfront option fee, usually 2% to 5% of the home's price, which is credited toward your eventual down payment. Lease periods typically last 1 to 3 years, and you'll pay a rent premium of 15% to 20% above the local market rate. These extra payments help build equity, often adding up to 1% to 2% of the home's value each year. The purchase price is usually set at the start of the agreement, locking in your cost and protecting you from future price jumps. At the end of the lease, you'll need to qualify for a mortgage, often with tougher credit standards than a standard purchase. Most contracts now require the agreement to be recorded with the county, and many include language that lets you walk away if you can't secure financing, though you'll forfeit the option fee. Land contracts, sometimes called contracts for deed, operate like seller financing. You take possession of the property while the seller holds the title until the contract is fully paid. Down payments range from 5% to 20%, and interest rates are typically 1% to 2% above conventional loans. These contracts run 5 to 15 years, often ending with a balloon payment. Recording the contract with the county is important to protect your equity. Until you own the title, the seller remains responsible for property taxes and insurance in most states. Some states require that each payment reduces the principal balance, not just interest. Land contracts are most common when buyers face challenges with credit or the property doesn't qualify for regular financing. Co-buying has gained traction, especially among friends, siblings, or unmarried couples pooling resources. All parties are listed on the loan and title, and lenders use combined income and debts to determine how much you can borrow. Some programs allow non-occupant co-buyers to help with qualification. It's important to create a detailed agreement that spells out each person's share, responsibilities for expenses, and procedures for buyouts or selling. Title can be held as joint tenancy, tenancy in common, or through an LLC. Some lenders now offer mortgages specifically designed for co-buyers, with flexible underwriting for non-traditional arrangements. Tiny homes have more financing options than in the past, but still face hurdles. If the home is on a permanent foundation and meets building codes, you may be able to get a conventional mortgage. For homes on wheels or in RV parks, personal loans or specialized tiny home loans, often with 10 to 15-year terms and higher interest rates, are more common. Down payments usually range from 10% to 20%. Zoning laws and resale markets for tiny homes vary widely by region, so researching local rules is essential before committing. Manufactured homes offer a lower entry price, but loan options depend on how the home is set up. Those on permanent foundations and titled as real property can qualify for FHA or VA loans. Movable manufactured homes require chattel loans, which come with higher rates and shorter terms, usually 20 to 25 years. Down payments range from 5% with government-backed loans to 20% for conventional financing. Many lenders won't finance homes built before 1976. Land home packages, where you buy both together, often get better terms than buying separately. Co-op purchases involve buying shares in a corporation that owns the building, rather than the property itself. Approval is required from the co-op board, and the process can take longer than a typical home purchase. Financing is available through co-op-specific loans or personal loans for the share price. Monthly fees cover building expenses and utilities, but equity builds more slowly than in condos or houses. Some co-ops restrict resale prices or limit who can buy, so it's important to review all rules before committing. Community land trusts help keep homes affordable by separating land ownership from home ownership. The trust owns the land while you buy the structure at a below-market price. Income limits apply, usually 80% to 120% of the area median income, and resale restrictions ensure affordability for future buyers. Mortgages work much like traditional loans, but are usually for smaller amounts. Homeowners build limited equity and often have access to support and education through the trust. Lease purchase agreements let you rent with the option to buy, with a portion of rent payments, typically 10% to 25%, credited toward your down payment. Lease terms usually last 1 to 2 years, with a preset purchase price. Unlike rent-to-own, these agreements don't require a large upfront fee. Buyers must still qualify for a mortgage at the end. Some agreements allow you to extend the lease if you need more time to improve your credit or savings. Seller financing has become more formalized, often requiring underwriting similar to a bank loan. Interest rates must meet IRS minimums, and terms usually run 5 to 10 years with a balloon payment at the end. Down payments average 10% to 20%. The deal is recorded as a deed of trust or mortgage, and third-party servicing companies handle payments. Title insurance is more complex with seller financing, and these arrangements work best when the seller owns the property outright. These alternative ownership paths each have their own requirements, costs, and risks, but they can open the door for buyers who don't fit the standard mortgage mold. Once you've secured a home, whether through a traditional or alternative route, the next challenge is managing the financial realities that come with owning property. Post-purchase survival guide. After closing on a home, the focus shifts to managing the ongoing responsibilities that come with ownership. The first step is building a financial cushion. Set aside 3 to 6 months of mortgage payments in an emergency fund. For a $1,500 monthly payment, this means having $4,500 to $9,000 ready for unexpected job loss or major repairs. Your emergency fund should also cover essential bills like utilities and insurance, not just your mortgage. Maintenance is a constant part of homeownership. Plan to spend 1% to 3% of your home's value each year on upkeep. For a $250,000 property, that's $2,500 to $7,500 annually. Older homes usually require more frequent repairs, so adjust your budget if your house isn't new. Set up a separate savings account for these costs. Schedule regular services, such as HVAC tune-ups, and keep receipts for major repairs. Replacing big-ticket items like roofs or furnaces can cost $5,000 to $15,000, so tracking the age of these systems helps you plan ahead. Utility bills often come as a surprise to new homeowners. Average costs for electricity, gas, water, and trash run $400 to $800 per month, depending on the size and age of your home. Larger or less efficient homes cost more to heat and cool. Until you know your typical usage, overestimate your budget. Some utility companies offer balanced billing programs, which spread seasonal spikes across the year to help with cash flow. Property taxes are another ongoing expense. Most areas reassess property values every 1 to 3 years, and increases can happen even if you don't make improvements. If you receive a higher assessment, you have the right to appeal. Gather evidence like recent sales data or photos of comparable homes to support your case. Appeals often have tight deadlines, usually within 30 to 60 days of receiving your notice. Insurance should be reviewed annually. Standard homeowners insurance doesn't cover every risk. Floods and earthquakes require separate policies. Premiums can rise as rebuilding costs increase. Bundling home and auto insurance may save you 10% to 20%. Consider raising your deductible from $500 to $1,000 to lower your premium, but make sure you have enough in savings to cover it if needed. Periodically update your coverage amounts to reflect current repair or replacement costs. Refinancing can lower your payment if rates drop by at least 0.75% to 1%. Calculate your break-even point by dividing closing costs by your expected monthly savings. If you plan to stay in your home beyond that period, refinancing may make sense. Cash-out refinances require more equity and come with higher rates, while rate and term refinances need less equity but still have minimum requirements. Home equity loans and lines of credit HELOCs, are options for accessing cash, but they come with different terms. HELOCs usually have variable rates and a 10-year draw period, while home equity loans have fixed rates and longer repayment terms. Most lenders require at least 15% to 20% equity in your home. Rates for these products are typically higher than for primary mortgages, so compare offers carefully. Renovations don't always pay back dollar for dollar. Kitchen and bathroom remodels usually return 60% to 80% of their cost, while adding square footage brings a lower return. Focus on mid-range improvements for the best balance of cost and value. Energy-efficient upgrades may qualify for tax credits and can lower your utility bills over time. Selling your home is also affected by timing. Spring and early summer generally see the most buyer activity, while winter tends to be slower. Local market trends and school calendars can influence the best time to list. Avoid selling when there's a large inventory of similar homes, as this can drive down your price. Keep your financial records organized. Store mortgage statements, insurance policies, utility bills, and receipts for repairs in dedicated files. Digitize key documents and track home improvement expenses, as these can reduce capital gains taxes when you eventually sell. Routine maintenance prevents larger problems. Set reminders for tasks like changing HVAC filters, testing smoke detectors, and cleaning gutters. Note warranty expiration dates for appliances and major systems. Schedule professional inspections every few years to catch issues early. Budget for periodic expenses like driveway sealing, exterior painting, and landscaping updates. Understand the tax rules that apply to homeowners. Mortgage interest deductions phase out above certain loan amounts, and property tax deductions are capped. Home office deductions require exclusive use of a space and thorough documentation. Some energy-efficient upgrades qualify for credits, so keep records of these investments. Monitor your home's value with occasional market analyses, but don't react to short-term price swings. Prioritize paying down your mortgage principal and avoid tapping equity unless necessary. Developing basic repair skills for small jobs can save money, but leave complex work to licensed professionals. Build relationships with contractors before you need them and verify their credentials. Plan for seasonal and variable expenses, such as heating in winter or cooling in summer. Installing programmable thermostats and adding insulation can help control energy costs. Many utilities offer free or discounted energy audits, which can identify ways to improve efficiency. Finally, review your mortgage terms so you know when your payment might change, especially if you have an adjustable rate loan. Make sure any extra payments you make are applied to the principal if that's your goal. Staying organized and proactive helps you avoid surprises and keep your finances stable. With these strategies in place, you can better manage the demands of homeownership and keep your budget on track. But before you even get to this stage, it's important to know what your income can actually buy in today's market. The $75,000 reality check. For buyers earning $75,000 in 2025, the numbers lenders use to determine your home buying range are more rigid than ever. Most banks will approve you for a home priced between $225,000 and $275,000, assuming you have a 20% down payment and very little other debt. This range is shaped by the average 6.5% interest rate on 30-year fixed mortgages and the 43% debt-to-income cap, now common with conventional loans. With a gross monthly income of $6,250, lenders use your pre-tax earnings, not your take-home pay, to run these calculations. A typical scenario: you buy a $250,000 home with 20% down, resulting in a $200,000 mortgage. At a 6.5% rate, principal and interest come to about $1,264 per month. Adding property taxes, around $230 per month at a 1.1% effective tax rate, and homeowners insurance, about $100 monthly, your total payment is roughly $1,594. This fits within lender guidelines, as it sits well below the 28% of gross income front-end ratio. If you put less down, costs go up. A 10% down payment on a $250,000 home triggers private mortgage insurance, adding about $125 per month and bringing your total payment to $1,794. FHA loans with 3.5% down increase costs further, as both upfront fees and higher monthly insurance apply, raising payments to nearly $1,983. Lower down payments reduce the cash you need up front, but raise your ongoing expenses. Interest rates have a direct impact on what you can afford. That same $200,000 loan at 6% would cost $1,199 per month. But at 7.5%, it jumps to $1,432. Even a small shift in rates can change your approved loan amount by tens of thousands of dollars, so locking your rate at the right time is critical. Your debt-to-income ratio can be improved before you apply. Paying down credit cards to below 30% of their limits, holding off on new car loans, and reducing other monthly debts can all increase your purchasing power. Student loans are now often calculated at 0.5% of the balance for DTI, so making extra payments can help. Keep in mind, though, that utilities and most subscription bills are not included in these calculations. Location changes the equation dramatically. In some Midwest or Southern cities, $250,000 might buy a 3-bedroom house with a yard. In expensive coastal markets, that same amount might only get you a small condo. Property taxes range from 0.3% in some states to over 2.5% in others, and insurance premiums can double in regions prone to natural disasters. These local variations mean it's important to research your target area's costs before setting your budget. Trade-offs are often necessary. Opting for a condo instead of a single-family home can reduce maintenance and insurance costs. Older homes may be cheaper up front, but come with more repairs. Choosing a neighborhood farther from the city center can mean lower prices, but higher transportation costs. Smaller homes, or those needing cosmetic updates, can also stretch your budget further. If you're willing to compromise, look at neighborhoods just outside the most popular areas, where prices are often 10% to 15% lower. Suburbs with good transit connections can offer better value, and homes that need only minor updates may be listed below market value. Focusing on these kinds of adjustments can help you stay within your means. Timing your purchase can also improve affordability. Saving for a larger down payment, working to raise your credit score, or shopping during the winter months when prices dip can all make a difference. Tracking local market cycles and being flexible with your move-in date can help you find better deals. Government-backed loan programs are another option. FHA loans allow for lower down payments if your credit is solid. VA loans offer zero down to qualifying veterans, and USDA loans are available in some rural areas. Many states and cities also have first-time buyer programs that provide down payment assistance or reduced rates, provided you meet their requirements. Don't forget to include all housing costs in your budget. When you add utilities, maintenance, and possible HOA fees, your true monthly cost may rise to $2,200 or more. This can easily approach 35% of your take-home pay, so it's important to be realistic about what you can comfortably manage. Some buyers offset costs by renting out a spare room or basement. If you can reliably collect $800 to $1,000 in rent, this can make a major difference in your monthly budget. Lenders may count a portion of this income if you can document it, especially in multi-unit or accessory dwelling setups. Looking ahead, consider your potential for future income growth. If you're in a stable career with predictable raises, stretching your budget slightly may be manageable. For those with variable income, keeping housing costs lower can provide more flexibility and peace of mind. Alternative lenders and credit unions sometimes offer more flexible terms, and some will consider non-traditional factors like rent payment history. Shopping around can help you find a better fit if you fall outside the standard approval box. Closing costs, often 2% to 5% of the purchase price, are another important factor. On a $250,000 home, this means budgeting an additional $5,000 to $12,500 up front. Some lenders allow these costs to be rolled into your loan, but this increases your monthly payment. Buying on a $75,000 salary is possible with careful planning, realistic expectations, and a willingness to make trade-offs. Keeping your total housing payments, including taxes and insurance, around $1,800 per month leaves enough room in your budget for savings, emergencies, and day-to-day expenses. Understanding these numbers helps you make informed decisions and avoid overextending yourself as you move forward in the home buying process. Buying a home on a $75,000 salary in 2025 means weighing tighter lending standards, higher rates, and increased living costs. Focus on your credit score, total debt payments, and the specific costs in your target area. Get pre-approved to see how your numbers work with today's rules, but compare that approval to your actual monthly budget, not just what a lender says you qualify for. If the timing or numbers don't work, consider waiting to improve your credit or save more. Homeownership is a long-term commitment, and sometimes patience leads to better options. For more detailed tools and